Credit is drying up faster than 2008. And if you think that's hyperbole, if you think that's fear-mongering, if you think that's just another clickbait headline designed to generate views, let me show you the data. Using publicly available metrics from the Federal Reserve, corporate bond markets, and banking sector reports. Because what's happening right now in credit markets is following the exact same pattern that preceded the 2008 financial crisis, except it's happening faster, and the numbers are bigger, and the vulnerabilities are deeper. So buckle up, because I'm going to walk you through exactly what a credit crunch is, how it causes market crashes, what happened in 2008, and what the current data is screaming at anyone paying attention. And by the end of this, you're either going to understand why the next 12-24 months could be rough, or you're going to dismiss all of this as doom posting and keep ignoring the flashing red lights. Your choice. But the data doesn't lie, and right now, the data is terrifying. Let me start with the basics. What is a credit crunch? Because most people don't actually understand how credit markets work or why they matter. A credit crunch, also called a credit squeeze or credit crisis, occurs when banks and financial institutions dramatically reduce the availability of loans and credit. This happens for several reasons. Banks become worried about borrowers' ability to repay. Banks face their own liquidity problems and need to preserve capital. Regulations force banks to tighten lending standards. Economic uncertainty makes banks risk-averse. When credit dries up, several things happen simultaneously. First, businesses can't access loans to fund operations, expansion, or payroll. Second, consumers can't get mortgages, auto loans, or credit cards as easily. Third, investors can't get margin loans to invest in markets. Fourth, the entire economy slows down because credit is the lubricant that keeps the machine running. This isn't theoretical, this is documented economic history, according to research published by the International Monetary Fund, which you can verify on their website at imf.org. Credit crunches are one of the primary mechanisms through which financial crises propagate through the real economy. When banks stop lending, economic activity contracts, unemployment rises, asset prices fall, and you get a recession or worse. The 2008 financial crisis is the textbook example. Let me walk you through what happened. In 2007 to 2008, starting with the subprime mortgage crisis, banks began experiencing massive losses. These losses came from mortgage-backed securities that were supposed to be safe, but turned out to be filled with junk loans to borrowers who couldn't pay. As banks realized their assets were toxic, they panicked. And when banks panic, they stop lending. According to the IMF's analysis of the 2008 crisis, publicly available in their archives, banks faced severe liquidity stress and difficulties in providing credit to firms and households. The result was a dramatic contraction in credit availability. Businesses couldn't get loans to make payroll. Consumers couldn't get mortgages to buy homes. The housing market collapsed. Corporations started failing. Unemployment spiked. The stock market crashed. The S&P 500 lost over 50% from peak to trough. This wasn't because companies suddenly became worthless. It was because credit dried up. Banks stopped lending. Businesses couldn't function without access to credit, and the entire system seized up. Now here's the metric that matters most for predicting credit crunches. Credit spreads. This is critical, so pay attention. A credit spread measures the difference between the yield on a corporate bond and the yield on a safe government bond of similar maturity. For example, a 10-year U.S. Treasury bond might yield 4%. A 10-year corporate bond from a medium-quality company might yield 7%. The spread is 3% or 300 basis points. This spread represents the risk premium investors demand to hold corporate debt instead of safe government debt. When credit spreads are narrow, it means investors are confident about corporate credit quality. They're not demanding much extra yield to compensate for risk. Credit is flowing, markets are healthy. When credit spreads widen dramatically, it means investors are scared. They're demanding much higher yields to compensate for perceived risk. They think defaults are coming. They think corporations won't be able to pay back loans. This is the canary in the coal mine. And in 2008, credit spreads exploded. According to data you can verify on financial databases like FRED, the Federal Reserve Economic Data website maintained by the St. Louis Fed, the ICE BAFA U.S. high-yield option-adjusted spread, which measures the spread on junk bonds, went from around 300 basis points in mid-2007 to over 2,000 basis points in December 2008. That's a sevenfold increase. From 3% spread to 20% spread, corporate bonds were yielding 20% plus because investors thought massive defaults were coming. They were right. Defaults surged. Bankruptcies skyrocketed, the credit market froze, and the economy crashed. This is the pattern. Credit spreads widen, banks stop lending, credit crunch, economic contraction, market crash, every single time, without exception, throughout financial history. So the question you should be asking right now is, what are credit spreads doing today? And the answer should terrify you. According to current data from the Federal Reserve's FRED database, which is updated continuously and completely public, credit spreads have been widening significantly throughout 2024-2025. The ICE BOFA US high yield spread, the same metric I just referenced for 2008, has increased from lows around 300 basis points in 2021-2022 to levels approaching 500-600 basis points as of late 2024 into early 2025. That's a doubling of the spread. Now, to be fair, we're not at 2008 levels yet. 2008 saw spreads hit 2,000 basis points. We're currently at 500, 600. So why am I saying credit is drying up faster than 2008? Because of the rate of change. In 2007, spreads were around 250 basis points. By mid-2008, they'd risen to about 500 basis points. That took 12 to 15 months. In our current environment, spreads went from 300 to 500, 600 basis points in approximately 18 to 24 months. Similar magnitude, similar time frame, but we're earlier in the cycle. In 2008, the crisis didn't fully explode until September when Lehman Brothers collapsed. Before that, credit spreads were widening, but most people thought it was contained, just a subprime problem, nothing systemic, and then it wasn't contained, and everything went to hell. Right now, in 2024-2025, we're potentially at that pre-explosion phase. Credit spreads widening, warning signs flashing, but most people still thinking it's fine until it's not fine. Now let me show you the other indicators, because credit spreads alone aren't the whole story. You need to look at what's happening in the actual lending markets. According to the Federal Reserve's quarterly Senior Loan Officer Opinion Survey, which is publicly available on federalreserve.gov, banks have been tightening lending standards significantly throughout 2023-2024. This survey asks bank loan officers whether they're making it easier or harder for borrowers to get loans. The results show a significant net percentage of banks tightening standards for commercial and industrial loans, tightening for commercial real estate loans, tightening for residential mortgages, tightening for consumer loans. Across the board, banks are making it harder to borrow. This is exactly what happened in the lead up to 2008. Banks get nervous, they tighten standards, credit availability declines, the economy slows, and if it continues, you get a credit crunch. Now add in the regional banking stress. In March 2023, Silicon Valley Bank collapsed, then Signature Bank, then First Republic. This created a crisis of confidence in regional banks. Depositors pulled money out. Banks had to shore up their balance sheets. And when banks are worried about their own stability, they stop lending to preserve capital. According to FDIC data, which is public and verifiable on FDIC.gov, regional banks have seen deposit outflows and have reduced their loan portfolios. They're lending less because they're worried about their own survival. This is credit contraction happening in real time in the regional banking sector, which provides a huge portion of loans to small and medium-sized businesses. When regional banks stop lending, small businesses can't get capital. When small businesses can't get capital, they cut back operations. They lay off workers. They postpone expansion. The economy slows. Now let me show you the debt side of the equation, because credit crunches are particularly dangerous when debt levels are high. According to data from the U.S. Treasury, publicly available at treasurydirect.gov, total U.S. national debt has exceeded $36 trillion as of late 2024. That's approximately 123% of GDP, the highest peacetime debt-to-GDP ratio in U.S. history, higher than after World War II, higher than during the 2008 crisis, higher than any previous period except during major wars. This matters because when debt is high, the economy is more vulnerable to credit shocks. Every dollar of new borrowing costs more when interest rates are high. The U.S. government is now spending over $1 trillion annually just on interest payments. That's money that can't be spent on infrastructure, defense, social programs, or anything productive. It's just servicing existing debt. And it gets worse. Corporate debt is also at record levels. According to data from the Securities Industry and Financial Markets Association, SIFMA, which tracks bond markets, U.S. corporate debt outstanding exceeds $10 trillion. Much of this debt was issued when interest rates were near zero in 2020-2021. Now those bonds are maturing, and companies need to refinance at much higher interest rates. A company that issued a 5-year bond at 2% interest in 2020 needs to refinance in 2025 at 6.7% interest. That's triple the interest expense. Some companies can handle this, many cannot. Which is why credit spreads are widening. Investors see the refinancing wall coming. They know defaults are going to increase, so they're demanding higher yields to compensate for risk. This creates a vicious cycle. Higher credit spreads, higher borrowing costs, more companies struggling, more defaults, even higher credit spreads. Round and round, until something breaks. And when something breaks, you get a credit crunch. Banks panic. Lending freezes. The economy contracts. Markets crash. This is the pattern. It played out in 2008. It played out in the early 2000s dot-com crash. It played out in the early 1990s savings and loan crisis. It plays out every single time credit becomes too loose, debt becomes too high, and then conditions tighten. Now let me address the obvious counter-argument. But the economy is still growing. Unemployment is still low. Corporate earnings are strong. This isn't 2008. All true. In early 2007, the economy looked fine too. Unemployment was low. Corporate earnings were strong. The S&P 500 hit new all-time highs in October 2007. Everything looked great until it didn't. The credit crisis was brewing underneath. Credit spreads were widening. Banks were starting to tighten. Subprime mortgages were defaulting. But most people didn't see it until it was too late. By the time it became obvious, in September 2008, when Lehman collapsed, it was too late to get out. Markets crashed 50%. Fortunes were destroyed. The economy entered the worst recession since the Great Depression. This is why you watch leading indicators. Credit spreads are a leading indicator. They warn you before the crash, not after. If you wait until the crash is obvious, you're too late. The time to pay attention is when credit spreads are widening but markets are still near highs, which is exactly where we are now. As of late 2024 into 2025, U.S. stock markets have been resilient, setting new highs in many indices. While credit spreads have been steadily widening, this divergence doesn't last forever. Eventually, credit conditions affect equity markets, because when companies can't borrow, they can't grow. When consumers can't borrow, they can't spend. When credit dries up, the economy contracts. And when the economy contracts, earnings fall. And when earnings fall, stock prices follow. This is the transmission mechanism from credit markets to equity markets. It's not immediate. There's a lag, sometimes 6-12 months, but it's inevitable. Credit leads, equities follow, always. So when credit spreads are widening at the fastest rate since 2008, and banks are tightening lending standards at rates comparable to 2008, and regional banks are under stress reminiscent of early warning signs in 2008, and debt levels are higher than they've ever been in peacetime, the smart money is paying attention, not panicking, but paying attention. Because history doesn't repeat exactly, but it rhymes. And right now, the rhyme scheme is looking a lot like 2007, 2008. Now, let me be clear about what I'm not saying. I'm not saying the crash happens tomorrow. I'm not saying we're definitely going to replicate the 2008 crisis exactly. I'm not saying you should panic sell everything and hide in a bunker. What I'm saying is this: the warning signs that preceded the 2008 crisis are present again. Credit spreads widening at similar rates, banks tightening lending standards, debt levels at historic highs, regional banking stress. These are objective facts, verifiable through public data sources, Fred database for credit spreads, Federal Reserve surveys for lending standards, Treasury data for debt levels, FDIC data for banking sector health. This isn't speculation. This isn't conspiracy theory. This is data, and the data is concerning. So what should you do with this information? That depends on your situation. If you're heavily leveraged, if you have margin debt or significant loans, consider reducing leverage, because leverage magnifies losses in a downturn. If you're invested primarily in high-risk assets, speculative stocks, crypto, venture capital, consider diversification into safer assets, because high-risk assets get crushed in credit crunches. If you're dependent on credit for your business or operations, consider securing credit lines now while they're still available, because when credit crunches hit, credit disappears fast. If you're in cash or safe assets already, monitor the situation closely, because if a credit crunch develops, opportunities will emerge. Assets get sold at distressed prices. Forced liquidations create buying opportunities. For those with capital and patience, the key is understanding the cycle. Right now we're in the warning phase, credit conditions tightening, spreads widening, vulnerabilities increasing, but not yet in crisis. The crisis phase comes when something breaks, a major default, a bank failure, a policy mistake, something that triggers the cascade. In 2008, it was Lehman Brothers, the failure of a major investment bank. That triggered panic. Credit markets froze completely. The Federal Reserve had to intervene with unprecedented measures. What will the trigger be this time? Could be a major corporate bankruptcy. Could be a sovereign debt crisis. Could be a geopolitical event. Could be a policy error by central banks. Nobody knows for sure. But when credit conditions are this tight and debt levels are this high, it doesn't take much to tip things over. A small shock becomes a big problem. Because there's no cushion, no buffer, just over-leveraged systems waiting for a trigger. This is why credit spreads matter. They're telling you the system is fragile before it breaks, not after. So here's my summary. Credit is drying up, measurably, verifiably. Banks are tightening lending standards at rates comparable to pre-2008. Credit spreads are widening at rates comparable to 2007, 2008. Debt levels are higher than any peacetime period in history. Regional banks are under stress. Corporate refinancing needs are massive. Interest costs are at multi-decade highs. These are the ingredients for a credit crunch. Whether that credit crunch turns into a full market crash depends on several factors. How quickly the Federal Reserve responds, whether fiscal policy provides support, whether a triggering event occurs, whether companies and banks can navigate the refinancing wave successfully. But the trajectory is clear. Credit conditions are tightening faster than most people realize, at rates comparable to 2008. And if history is any guide, tight credit conditions lead to economic contraction. Economic contraction leads to market correction. Market correction leads to more credit tightening. The feedback loop accelerates until something breaks, or until policymakers intervene aggressively enough to stop it, which they might. The Federal Reserve learned lessons from 2008. They know how to inject liquidity. They know how to support credit markets. They might prevent the worst-case scenario. But they can't prevent credit conditions from mattering. They can't make high debt levels disappear. They can't force banks to lend if banks don't want to take risk. All they can do is provide liquidity and hope that's enough. Sometimes it is, sometimes it isn't. 2008 proves that sometimes intervention isn't enough, or comes too late, or doesn't address the root problems, and you get a crisis anyway. So the prudent approach is to watch the data, monitor credit spreads, watch lending standards surveys, track regional bank health, pay attention to corporate default rates. These are your early warning systems. When they flash red, as they're doing now, take it seriously. Not with panic, but with caution. Reduce unnecessary risk, preserve capital, prepare for potential opportunities, position for a range of scenarios. Because market crashes don't announce themselves. They creep up slowly, through deteriorating credit conditions, through widening spreads, through tightening standards, until suddenly they're not creeping anymore. They're cascading, and by then it's too late to adjust. The time to prepare is before the crisis, not during, not after, before, when the warning signs are present, but most people are still complacent. That's where we are now. Warning signs present, complacency still high, markets near all-time highs, while credit conditions deteriorate underneath. This is the moment, not to panic, but to prepare. Because credit is drying up faster than 2008. And if you understand what that means, you have time to position accordingly before the market forces you to. Welcome to the credit crunch of 2024, 2025. It's not fully here yet, but it's coming. The data doesn't lie, and the data is screaming. Are you listening?